So today's chapter is going to be online security offerings and transactions. We all know that we are interested in investing in stocks and securities. We want our money to, bring us more money. And like all investors do, they put their money in a varied group of investment opportunities. You don't put all your eggs in one basket. You make sure you're investing something in stocks, something in purchasing physical assets like land or buildings. You might actually invest in creating an enterprise. So you're trying to put all your money in different places so that you can diversify the risk, you can maximize the return. And one of the places where you can invest your money is definitely online stocks and security offerings. So this is where we are interested today to discuss stuff. And where does, say, cyber law come into picture? Where does the internet come into picture? Where does the cyberspace get involved? And what kind of threats we have on the cyberspace while we try to transact business, whether we are individual investors or institutional investors or investment bankers. We might be putting our money somewhere, and because of the internet space, all our data, all our information, everything could be at risk. And there is a lot of legislation which tries to protect against that, including the stuff that we discussed while we were talking about how do we protect intellectual property, different types of intellectual property. And today's focus is understanding the stock markets, the securities market, the transactions that can happen, and the kind of risks that we might perceive, and how do we educate ourselves? How are we more aware of what happens in the financial markets? And because if you're more aware, that you're more informed, you stay more vigilant and more careful and protect yourself against all kinds of frauds that can happen in an internet space, in the financial market space. So what are online security offerings and transactions? You understand that there are a lot of alternatives for businesses to secure money, to secure capital. And because without money, without capital, even your best ideas, you cannot take it from an idea phase to an implementation phase where you create proof of concept, you create a prototype, you create a model, you're ready for commercial production. You have done your market analysis, you know exactly what consumers require, and you have a marketing plan in place, and you're able to sell your products or services. But for doing all that, you need capital. And there are several ways you can secure capital or money or finance to get your great ideas into something that we call as tangible business, offering products and services. So one of the most attractive ways of securing capital is to be able to issue equity securities to investors. So suppose, let's assume I have a great idea, or bunch of our team members in this class together with me have a great idea. We can go and make sure that we create a prototype, a proof of concept. We have done our market analysis. We have done a design. We have maybe gone to China to get a nice prototype made and look at the functionality, look at the durability, the features of the particular product. We can advertise on, say, Kickstarter or any of the crowdfunding sources, or we can create a web page where people get to know who we are, what our intentions are, what our great innovative product is, and hoping that we will be able to attract equity securities, in the form of investors, so that they can give us the capital for us to be able to take our brilliant idea, a great prototype and a model that we demonstrated through a video or social media, and say, hey, we need the money. This is our great idea. We are resolving a problem that customers have. We have a very innovative solution, but where's the money? It's you guys are the investors. Please give us the money. And great ideas, great business plans, great prototypes and models get us the kind of capital that we are looking for. And one of the ways is to secure that capital by issuing equity to investors. So there are a number of other methods to finance your business, like you can take a loan from a bank and get started. You can issue bonds, but these are all going to create that kind of immediate financial burden because you're repaying back the interest on the loan that you have taken. You have to pay back a percentage on the bonds that were issued. So these create immediate burden from day one. As soon as you secure a loan, they'll give you a month or two to wait. Like if I took a mortgage, a loan for buying my home, they give you a couple of months grace period, and then the loan EMI starts happening. The interest burden starts getting heavy. You haven't even started yet. You haven't even sold your first product, and the financial burden starts accruing. So, that's the downside risk that you have for going through loans or issuing bonds. So and also if you're going for a loan, a business must first qualify for a loan. The valuation or underwriting process is pretty rigorous because you've got to show that you had, say, the credit rating. You also had some properties to back yourself with. You have a contract where you have a regular income that you can back on. And all these are vetted before they actually say, hey, you're ready to be issued a loan. And loans are pretty much possible for companies that are only at a later stage in terms of they've already established themselves, they're doing business, then now they secure extra money through a loan to say, for example, expand, to open new branches elsewhere. It is much more easier for them because they have very less burden in terms of paying back the interest because there's a continuous cash flow that's happening. And for early stage companies, for startup companies, loans create a burden right from the word go, which is very difficult for any business to manage when they're starting up. So if a loan even comes through and it materializes, the interest repayment rate may be substantially above the prime lending rate. And so it becomes expensive. You all know that taking loans it looks easy, but when it comes to paying back every single month, it just becomes that much more painful for individuals as well, and even for more so for businesses because the loan, quantity or amount is very huge. So this type of financing represents another expense on profit and loss statement as well as a liability on balance sheet if you took a loan. Bonds also issuing bonds have the same effect, and all the repayment may be delayed by some years, but it starts kicking in. Another way of raising capital for your company, if you want to start a business, is to talk to an angel investor or a venture capital investor. Maybe say you talk to Alibaba, they have an venture capital, unit that funds great ideas and great products. Apple has a venture capital fund. It's called the I Fund. Amazon has a venture capital fund. They fund great ideas and great startup companies. And you can approach these venture capital investors, or sometimes they're called as angel investors, and they take control of a portion or a percentage of your ownership of the company. So they're not giving you that money for nothing. They're giving you that money because you have a great product idea or a service idea. And more so, they'll say, hey, in return to the money that we're giving you, can we get a 30% ownership? It's like a negotiation that you have to be strong at. Maybe you'll say, not 30%, I can only give you 15%. I can't give you that much of control on how I manage this company because I'm pretty confident. I'm going to make a ton of money here. It's going to sell. It's going to be very profitable. We appreciate you giving us the capital, but in return, we can only give you 15%. So this is another way of raising money for your business. I think today's class is going to help you think about it. Hey, it's not about money getting you to start a business. It's about great ideas and great products and services, innovative ways of thinking from your part, which can raise capital through different modes like issuing equity, going for loans, issuing bonds, going to an angel investor, venture capitalist. And you can raise money elsewhere, not just in the United States, across the globe, because of how good your idea is. If you're resolving a problem, which is pretty attractive, you can raise capital to get started on your business easily. So that's why, loans or bonds and other things, you kind of lose ownership or you're starting to pay interest, repayments, which can be burdensome. But if you want to go the route of offering securities or equity as a form of ownership, and in return you're getting cash, is really attractive because, you can raise capital and you don't have a definite repayment obligation because these people who are giving you equity, investors who are giving you equity, are also, shareholders. They have a little share of the capital of the business that you're starting. So access to capital increases by issuing equity, and although the ownership in the company becomes diluted to that percentage, because if say I purchase 10% of the shares, I have 10% ownership of the company. But however, the control is not exactly correspondingly diluted, meaning which the board of directors, anybody who's starting this company, still have a great control on the day-to-day operations, the decisions that are taken, the strategic direction that the company is headed for. It's not exactly the same level of dilution in terms of how much the ownership of an investor increases by. So investors generally do not participate in internal operations. That's why the control stays with you. You still have to give a pro rata ownership to the person who is investing, who is an equity shareholder, but they don't, they're not nosy. They don't get engaged in the internal operations strategies and decisions on a day-to-day basis. And that's where you keep a larger control. You secure capital, and you're not diluting the kind of control that you hope to have on the company, because this is your company basically. So controlling shareholders create a market. See, anybody who is investing in you as an investor or a shareholder, they create that kind of reputational capital for your company. They're creating a huge market for your shares to be traded. So liquidity improves as your company's performance improves. The demand for your shares, your company shares in the market space, in the financial market space, increases. So you're already out there. Everybody knows you because of the uh, good, strong investor portfolio that you have. These good investors have come and invested their money not without a reason. They're investing because they know your business is really resilient, it's sustainable, it's something innovative, it's going to grow. They have that kind of faith in you, and that's why they've invested. Just for the fact that they've come and invested in your business idea, in your business, is a massive plus for you in terms of market visibility, reputational capital, and the liquidity that your shares have, because there's more demand. So if any investor or a shareholder is willing to sell shares, and they can quote for a higher price, and they get sold quickly, improving your own company's liquidity. So companies can attract and retain employees because of stock options. See, all of you are smart people. So when you apply for jobs, also look at companies that offer stock options. Suppose you perform really well as an employee in the company that you go and work for. There are a lot of companies that give you shares. Every year, they give you stock options. They issue shares to you. So you actually become a part owner. You become a shareholder because they've given you shares in appreciation of the great work you're doing as an employee. They also offer you bonuses that can be tied to company performance in terms of stock performance and share price performance. These are wonderful things that can happen when a company goes through the route of issuing equity and raising capital, either for startup or for expansion plans that they might have. So you as an employee also can look at companies that have that stock option opportunities and bonus opportunities that are tied up with shareholder performance. So you can look at it from both sides. You're having a company, you raise capital through equity, you can give stock options, you can retain smart people because you have stock options. You also have bonuses for these smart people that are linked with the company share performance. That is if you're owner of a company. That's your way of looking at it. But suppose I'm an employee and I'm applying for a company, I would love to go and work for a company that has the opportunity for me to earn stock options, for me to earn bonuses that are linked with a company's stock or share price performance. Because then I feel a sense of ownership. I really want to do well because if my company performs really good, then my bonuses can increase. The shares that I own right now can increase, and both ways it's a positive. That's a good question, Abraham. You actually, as an employee, there's a lock-in period that companies are smart. They don't give you shares, without having a terms and conditions. So what they do is they have a lock-in period. So they say, hey, we gave you these many shares, and if you just choose to leave the company, it's a loss for the company. So they say, if you leave the company, you might have accumulated over the years a lot of shares. You can only sell a percentage of those shares that you actually own if you left right now. But if you left next year, a year later, then you can sell more percentage of the shares that you're actually holding. So it's a way to lock in smart people, to retain key personnel, having that kind of deferred option to sell shares and to trade, whatever. That applies to even bonuses. They say we have issued you a bonus, but there's a deferred component of the bonus. You have to stay one more year if you want the full bonus to appear in your bank account. If you were to choose now, you'll get a part of the bonus, but you're going to lose some. That's a way of locking you in. They're doing you a favor. They're not simply saying we give you a salary, we give you the benefits. We're giving you shares. We're making you our shareholder. We're giving you bonuses that are tied up with the share price performance. So we're doing way more to keep you motivated. But again, we don't want to lose you. So they can create some kind of formula that gives them an option to sell certain percentage of shares if they're left now and be able to sell more number of shares if they're left 1 year later, 2 years later. The same is the case with deferred bonus. You get some portion of the bonus right now. If you choose to leave now, you get a higher percentage of the bonus that you can encash if you're left 1 year later, even more if you're left 2 years later. That's the way of creating deferred bonus. A good question. Thanks for asking that. And from the investor standpoint view, they have ownership in a potentially profitable enterprise with two ways of increasing their wealth through dividend payment. Suppose I invested my money in a company that's going through the route of issuing equity. I'm thinking two ways. If this company is going to give me dividend payments year after year, maybe sometimes once every 2 years, because the performance of the company is going up, the shareholder price of the company is going up. The company might say, we want to reward our investors by giving them a dividend payment. So like a percentage calculation that they can do because they don't want to give all the surplus that they make because they might have plans for expansion. They have a strategic vision for the future, but percentage of that, high performance can be shared as a dividend payment in appreciation for the investors' confidence in investing in this company. And when the share prices, see, I'm an owner, right? Because I've invested, I have some shares with me. I get dividend payment on one side and my share prices are going up. So there are two ways of making more money as an investor. So I'm almost trying to tell you, hey, if you have money, you have the capital, go become an investor. Go take the route of buying stocks, but do it smart. You have to educate yourself in the finance space, not lose your hard-earned money. It can all vanish very quickly if you take decisions which are not smart enough. And again, as I said in the starting of the class, you don't put all your eggs in one basket. You need to know how to diversify your portfolio. In the process, you're diversifying the risk that is associated with trying to create that standard rate of return. A return on investment should be healthy, but not at the risk of a high risk kind of scenario where you might lose all your money. So you can look at it from different angles, from the company's perspective, from an employee perspective, and also as an investor perspective. Three different ways of looking at equity and securities. So this is an interesting class in terms of going into the financial space. We'll get to the cyber law and what happens because of internet and the kind of things that we have discussed in past classes. So what is a security? There's a definition by the Securities Act of 1933. It's a very broad definition. It could be a promissory note. It could be a stock that's issued. It's a treasury stock. It could be a bond, be a debenture, certificates of interest or participation in any non-profit sharing agreement. It could be a pre-organization certificate of subscription. It could be a transferable share, investment contract, CDs, which are called certificates of deposit, a put option, a call option, a straddle option, or in general, any instrument commonly known as security. So it's a very broad definition. What is a security? It's not cybersecurity we are talking of. We are talking of a financial security. So all of these are examples of what happens in the financial markets. The Securities and Exchange Commission is the administrator of all the securities law. There are hundreds of laws that are out there in the United States. I'm sure every country, every region has evolving nature of all the laws that protect against fraudulent practices, protect investors, protect advisors, curtail what happens in the financial market space without losing investor confidence. We don't want investors to lose confidence because that will become a problem. If you have a weak financial market system, the investors are not going to put their money because they know their money is not safe. So the Securities and Exchange Commission is what administers all these securities laws in the United States. And the courts have indicated they do not intend to be bound by legal formalisms of what is termed as a transaction. So they don't get into the granular detail of defining what a transaction is called, but they give a very broad sense of what a security could mean. And it's pretty broad. With that little background, the court was asked, this is an example that you might be interested in. The court was asked to decide whether the sale of an interest in a citrus grove was a security and thus subject to a securities law. So if you have a farm, you're growing some citrus fruits and stuff, is that considered a security? And would it be subject to any of the securities laws that are there in force? So the court created a risk capital analysis. So this is something that is evolving over a period of time. And so they created a risk capital analysis for this case and concluded an interest in the grove was a security because the transaction had these characteristics. That's the nature of the transaction that was involved. It's an investment, definitely yes. It's a common enterprise. There are several people who are interested in the operation of this particular citrus grove with a reasonable expectation of profit. Nobody's investing in that particular farm without any reasonable expectation of profit. They are expecting a profit to be derived from the efforts of a bunch of people who are working on the farm itself. With these conditions being satisfied, the court said it is a security, right? So it's pretty broad. I mean, this is just an example that I just discussed so that you have a better understanding. Now, the different securities laws governing the issuance of a particular equity, administration, transactions, and securities, there's so many laws. This course is cyber law, and that's why we're discussing laws at different points of time. But I can't just go into every single law and go in depth. It'll become really cumbersome. So I'll just give you an overarching view of what happens. In the US, it is the Securities Act of 1933, several sections that the Act has between Section 77A and 77AA. It also defines these things which are listed in the second bullet point. For every offering, equity offering or securities offering by a company, if they want to raise capital, they must have to create a prospectus. They have to make sure that available information, required information is available to any prospective investor. If I am looking at something, I should have complete information of what I'm looking for investing in. So if I'm an investor, I have to know what the offering summary is, a description and number of shares being offered in total. The underwriting, is there an investment banker which takes care of the offering, the sale of an offering, and how it is being sold, what is being communicated? That's an underwriting. And if some part of the offer is not sold, this investment banker, which is an underwriting company, uses those shares and purchases those shares. What kind of discounts this underwriting investment banker is offering? What does an underwriting investment banker have as commissions? How do they plan to distribute the shares? Of course, the prospectus should say, what happens to this money that we are investing? Use or proceeds. Dilution, if any, of outstanding shares. If there were outstanding shares, what happens to them? Dividend policy. Can we expect a dividend? When can we expect a dividend? A rough estimate of what percentage return on investment can we expect as a dividend. Any risk factors, a complete disclosure has to be made. Financial data, competitors, dependence on key personnel, lack of operating history, all these have to be factually stated. Adverse economic conditions in that industry, because I'm just an investor. It's not necessary I know all of this, so I have a right to know this. And that all has to become part of what we called as prospectus. Every company that's planning to issue securities or equity have to have in their prospectus all these information in pretty much clear detail. Other matters such as property, plant, equipment, legal proceedings, management information, large contracts that they've already signed, disclosure on financial statements. It's pretty, comprehensive document. Now, you might ask me, where is cyber law and the internet coming into picture? Earlier we used to have these prospectus mailed to your mailbox in a hard copy, in a physical copy. It used to be big books. This is a lot of information. So there are books that come to you and you have a chance to read it. And if you think you're satisfied, of course, you might go to an attorney, you might go to your investment, agent or an advisor. You might say, hey, this looks interesting. Can you give me a greater detail? Can you explain to me certain terms and conditions which I don't understand? Not everybody out there is a finance expert or an investment expert, right? So you can take the help of an advisory group if you choose to. You can also go to an underwriting company and an investment banker and say, can I understand what's going on here? Because I seem to be interested, but I'm not 100% sure. So that used to happen when they used to send you those big books. But right now, everything can be digitized. So obviously, these are in the form of documents, files. They could be sent to you through email. There's plenty going on the internet space. So things have changed how conventionally things were done before, including what used to happen with the prospectors. So moving on, There are a lot of regulations. A few regulations I've actually listed out here. Very broad, description of what each of these legislations do. So the Investment Advisors Act. Suppose I'm a financial advisor. It regulates investment advisors and seeks to check the power of advisors over company directors or investors. Private Securities Litigation Reform Act of 1995. This act imposes certain limitations on legal action, private lawsuits, imposing stricter pleading standards for class actions and limitations in discovery. Suppose you manage to find something wrong about a claim that is made by a company, and what happens in such cases if you were to pursue a lawsuit and it imposes stricter pleading standards so that these companies do not use their position or power to disadvantage the person who is filing a lawsuit against limitations on discovery, and they have a chance to go further and discover in greater detail any information that they think will help resolve a particular lawsuit. Public Utility Holding Company Act. This is very specific to utility companies like gas and water and all these kind of public utility services like power. So if you have things to do with, say, Avangrid or Regional Water Authority or, you know, uh, PSEG, all these public utility companies come under the purview. So if you're a consumer and you're actually investing in any of these public utility companies, what kind of consumer protection do you have? And so you're protected when you're dealing with companies that are in the public utility space. Oh, you all must understand public utility is big in any country, in any region, for every part of the world. Public utility is big. Just think about it: water, power. I mean, these are things that none of us can survive. If you did not have them, we take them for granted. But there are countries where these are a massive problem. And if you're investing in these public utility companies, you're making a good investment because these are important for every society, every country. But then what kind of protection you have as an investor? And that's governed by this particular legislation, which we called as Public Utility Holding Company Act of 1935. The information that must be reported under the Securities Exchange Act, the SEC, that's called how it's called in short. It mandates accounting and record keeping for domestic large capitalization companies, and the kind of record keeping that they should have information that these reports should include operations, financial conditions, management, financial statements, if there's an election to the board of directors and stuff like that, mergers and acquisitions. We talked about how Google continues to acquire tons of companies. I mean, mergers and acquisitions are a great way of trying to expand your company operations, but any such information has to be reported out. Tender offers, if you're actually contracting, working with suppliers and vendors, all these kind of things should be reported out. Beneficial ownership of shares and share transactions by insiders. You might have, certain people, certain investors, you prefer to offer them greater equity. You want to raise capital to certain closed group of individuals. If that is the case, who are the beneficial ownership of such type of preferential shares or any share transactions? If you have insiders transacting amongst themselves, those should be disclosed. Compliance with Foreign Corrupt Practices Act, because money can come in from across the globe. And this particular act, Foreign Corrupt Practices Act, tries to control any kinds of bribes that can happen over financial transactions. Now, the process of conducting a securities offering. So, if you're a company trying to offer securities or offer equity, what happens as a process? I had to put this slide in there because I'm not just assuming everybody's completely aware of the process. This is a very broad outline of how it works. So, the first part of the process is known as the pre-filing period, in which no statements regarding the sale of securities are made. They cannot be made because it's a pre-filing period. Again, where do you file all your papers and documents with? The Securities Exchange Commission. I mean, that's the SEC that we just talked about. After this is known as the waiting period between the registration and effective period, during which you've just put in your papers and you're waiting for the filing has started off and you're waiting for the registration to happen. And that's called the waiting period between registration and effective period. And the security, offering is out there. And during this period, statements can be made, and you can talk to the public. You can create any social media campaigns and stuff like that if you choose to. You can go on television as well. I mean, you can be available everywhere because this is a waiting period. It is during this time that companies typically undertake an advertising campaign, publicize their offerings, do a roadshow. Sometimes you think about it this way. Roadshows were very popular a few decades ago, but look at it now. Roadshows are in your home because it's digitized and the proliferation of internet across the globe. It is also critical that any information be verified before it is shared. That's where the control and regulation is happening. Should investors rely on any misstatements of the material facts, it could lead to a civil or criminal liability against the company. The offering is valued and shares are priced during this time period. So once all these things are taken care of, that's where we say, hey, based on all the factual information, the financial statements, the proposals, and the disclosure of important facts, the SEC can say, hey, we understand it. The offering is valued and shares are being priced during this time. Then comes the real part of it. The securities are sold and what is known as now an offering. This could be an initial public offering or the IPO, the short form of initial public offering. This is the first time you're going public and you're asking for investors to put in their money, invest money in your great business idea. The very first time that shares in a company are being offered to sale, or it could be a follow-on, or it's called as secondary offering. It could be another offering following the IPO, where you want extra capital, you want extra money for expansion, consolidation, whatever your strategy, you're pursuing an innovation or going into a globalized market space. It could be for any number of purposes that you could have a secondary offering. And you've established your reputation, you've established your company. Your company is really fully on, and you have cash flows to back yourself with. You have more information to disclose. A number of shares in these offerings can be allocated to large institutional investors, such as mutual or pension funds, because the size of the offering can also determine whether you want to do this or not. If the size of offering is massive, you might say, hey, I want a large company or an institution to back my offering. And you could allocate these to a large institutional investor. Again, furthering your reputational capital, making more liquidity in the secondary market space. A portion of shares can also be allocated to smaller retail investors whom you think should be given an opportunity to invest in your company. That's another strategy that organizations follow. And there is a post-effective period when securities are already being traded in the market space. You could purchase Tesla shares, you could purchase Microsoft shares right now, because that's a post-effective period. Any one of us can be an investor. We don't have to purchase a one full share if you don't have the money. You could have a fractional investment using all kinds of softwares, applications that you have, Robinhood. You can use a lot, BlackRock. There's so many ways you can create an account, and you can start buying a fraction amount of a share. Even if it's a very small fraction, it doesn't matter. This way you have an opportunity. Suppose you have only $10,000 to invest. You don't have to create a portfolio of only 2, 3 companies that you want to invest. That's high risk. You might want to create a portfolio of 20 companies, large, mid, and small cap companies. This way you can diversify your portfolio. How do you do so many companies together? You can just buy fractions of each of these 20 company shares. You're thinking smart. What happens if the market is hit and goes down? Not all companies will go down. So you're diversifying the risk. You're making sure at least you have a minimum return guaranteed on your $10,000 investment that you're making. So you have to think ahead of the game. Of course, you should know how to do fundamental analysis. You should know how to do technical analysis. You should be familiar with what happens in the stock markets. You're also looking at macroeconomic signals that are coming from what happens during elections. All these kind of policy changes that can happen when a new president is elected, or if a new government comes in, not just in the US, but across the globe, especially if you're dealing with multinational companies. So historically, investment bankers have the opportunity to underwrite or sponsor all security offerings. They promise to use their best efforts, because they're a huge investment banker, to market and sell the shares on your behalf. In return, they receive commission fee, whatever mode of operandi that you think it works for you. Traditional offerings are usually for those companies with seasoned management They also have established attorneys, accountants, and underwriters because they have the financial power. They have the option to use their specialized services of attorneys, accountants, and underwriters. The underwriters are also offer expertise in industry segments. They are also capable of making judgments on the ability of the offering company to grow and attract investors. How do you attract investors? Which industry do you target? How do you find your investment markets in? So these companies, investment banker companies that are called underwriters, have that knowledge, have that kind of access to information. Underwriters then aggressively sell the offerings that on your behalf, and they offer support after the offering in an attempt to minimize price volatility. They act as certification of market fitness because if you're backed by an underwriter, the market has more faith in your offering. That fundamentals of the offering company are sound. They are actually trying to say we're trying to certify that this company has sound fundamentals. Their policies, their strategies, their vision, their financial management is strong. So going through an underwriting can only help, but of course you pay a fee for their services. May have to pay a commission for whatever happens to your efforts. Now, the internet comes into picture because it's closing the capital gap between those large companies, the Fortune 500 large cap companies, and it's closing the gap between them and the small cap and micro cap companies. All of our offerings don't have to come from companies that are so large. You could be a startup company, a micro cap company, micro enterprise. That's something that you get to hear a lot these days. Each one of you has the option of creating your own micro business based on a very creative idea. It could be offered, your idea or your product, your service could be offered on TikTok, for example. It's a micro enterprise. You need money though. And so how do you create opportunities to raise capital for your smart idea, a micro enterprise using all the technologies that you have through internet? That's where everybody has an option, has access to capital across the globe in actually supporting their smart business idea. So these small companies, by virtue of the internet, are able to participate in offerings. Internet pretty much levels the field to the extent that small companies can compete for the same funds that are available across the market. It improves the efficiency of the entire capital market because everybody is aware, understands, participates to get access to the same fund that's available across the globe. Bridges the information gap between companies. As an investor, I have better knowledge of companies. Analysts, favorite clients, I can reach out to them. Individual investors, I can approach them because internet is available. Otherwise, if you have an investor who is from China or from Singapore or maybe Indonesia, how do you reach them without internet and without the technology? So it's pretty much leveling the playing field. You don't have to raise capital only in New York Stock Exchange. You could raise it in London Stock Exchange. You could raise it from anywhere across the globe. And that's all being possible because of internet. And we all know that. So delivery of an offering material, I know there is some dated information here, but I just kept it because it still sticks on. You have to deliver offering materials in a timely, adequate notice. That information should be available for all investors. And how do they have access to that kind of information of all the offering materials? It can happen through several ways. Paper format, very historically. You still have companies do that. Email, see a disk, CD-ROM, audio, video, all kinds of digital formats can be used to make sure recipients have access to this information in a timely manner with adequate notice. Evidence of delivery, the SEC, the Securities Exchange Commission requires reasonable assurance of delivery of all such information. And, that confirmation is essential. That's required. So this is still, going with the kind of legislations that are there. You also have an option to do private placement offerings. So this issue relates to offerings subject to bans on solicitation. PPOs are private by nature. So you could go and offer these offerings to private parties. I mean, when I say private players and private investors. So the internet actually can become a problem because anything that was intended only for a few investors, select investors, might become accessible through the internet, through the larger population. And that's a problem. We don't want that to happen. That's where you start beginning to see the role of internet. The positive side, it's leveling the field, giving you access to the financial markets across the world. That's great. But then you also have restrictions on how you want to do stuff, and that restriction is being violated because internet gives access. And where you have cyber attacks, other people are getting access to information which are they are not supposed to be getting. So the SEC has indicated it would approve password protected sites accessible only to those investors you would want to give access to. Yeah, that's where the cyber law policy and ethics is coming into picture. This brings up an interesting question of identification and authentication. So suppose I want only a specific group of investors to get these offerings. How do I secure their identity? How do I know that they are the right people who are accessing the internet, who are accessing the information, who have the opportunity to participate in an offering? So you need to have identification and then authentication of these investors, or else you don't know who is on the other side and trying to access stuff that they should not be accessing at all in the first place. Roadshows were, historically done before the internet. Company managements would conduct live presentations to a restricted audience of high net worth individuals. They would invite these high net worth investors, institutional investors, individual investors to generate greater interest in the offering during the waiting period so that you build up enough interest so that you actually make sure that whatever offering that you're giving, it can get completely subscribed or it can get oversubscribed because you've generated that interest through roadshows. But internet roadshows are permissible. Now, if the issuer denies access to its website to all except those sellers that they feel are they have a reasonable belief that they can qualify, they actually meet the qualifying status. So roadshows on the internet means you have to identify the investors you want them to come. Those are the invited investors. You need to authenticate that they are really the investors who are having access to these kind of internet roadshows. So you have to assign confidential passwords to each buyer, which is unique to a specific roadshow. That's where all the technology comes into picture. Password protection comes into picture. Hacking comes into picture, and the firewalls and security systems you want to have in place. This confidential information. This is high profile internal information of the company. Receives confirmation from each seller about the qualified status of each buyer. So there might be a roadshow, internet roadshow. Again, it's just not a normal roadshow, it's an internet roadshow. So every seller has to have a confirmation from every qualified buyer, and that has to go through an authentication process. And it presents a unique kind of situation where you might have no actual knowledge or reason to believe the buyer is not qualified. So moving on, dissemination of information. There are two major issues relating to releasing this information. And the first relates to who is disclosing the information. Is it something that we can trust? Is it really coming from the seller who wants to give this offering? Or is it some spam that's coming from somewhere and they want my money? I know a lot of examples where people get these emails and they kind of think these are authentic emails. They click on something which they shouldn't be, and then it leads from one thing to another. There's a lot of crime happening across the globe in terms of securing people's money. And these are not. So the first challenge is about who is disclosing financial information. The internet is an open forum, you know that, and we can reach millions of users at the same time, no cost, and you can target them by interest or income. Sometimes you can exploit them, like as I just said, they have no understanding of the financial market. They're poorly informed of what care they should take, and the trust factor comes into picture. Hacking comes into picture. A lot of crime can happen. Chat room, bulletin boards, and other sites. Financial gossip can be a problem, and all such challenges can make it really hard for both sellers as well as buyers. The quality of information disseminated on these sites is often questionable, as I just did mention. Some information may be true, but because there is no editorial control, how do we make sure that information only which is validated, vetted, can get across? Much information is not verified, and some of it may even violate the security laws, as well as other laws such as laws prohibiting defamation. So there's all kinds of things that can happen in the internet space. The second issue that we talk about internet roadshows and stuff is related to the dissemination of information concerns what is being disclosed and to whom. So concerned with the selective disclosure of material information by issuers of a public offering or a securities offering to only certain favored clients, analysts, or institutions about important information such as advance warnings on earning results and stuff like that. You want to only have that selective dissemination. So because it's confidential information. So what is being disclosed becomes even more important because you're doing dissemination of very confidential information to only select group of clients and analysts or institutions that should be aware of earning results and early warning of earning results that should be there. So we're coming to the last part of the chapter itself. If you have any questions, you might please feel free to ask. But the online transactions and securities have the same level of vulnerabilities that you have with privacy, identification, authentication of clients, and investor suitability. Are investors really capable of what they claim that they can invest? Are they trustworthy? Is there any money laundering involved? There could be a lot of questions that can be raised of an investor credibility or qualification. Best execution, how do we get these internet transactions secure? So the execution part of these transactions must be secure. Otherwise, I think I put my money in Apple stocks or say Tesla stocks, and I don't get any confirmation from the company that I've actually now become a shareholder, a fractional shareholder, because my money is gone. So I've been tricked into putting my money elsewhere, and so there's no example of best execution in this place. Market data. Are we sure the market data that we are reading as an investor is actually true? It's coming from a valid source, or is market data being manipulated? We are looking at data which is not true. System capacity, access problems due to volume, lack of adequate trading infrastructure. Not every country is like the United States or like in Europe, where you don't have power cards, you have really computing capacity that can support large volume of transaction, and internet proliferation is really widespread. In other countries, you might have a power outage, internet is not accessible everywhere. Even if it is there, the volume of transactions makes transactions very slow. So it's not a very advanced financial market. And you can create a lot of issues with lack of trading infrastructure as well. So, the percentage of investors in the US are far more and in comparison to the percentage of investors in different parts of the globe, because the infrastructure here is strong. Apart from having legislations that are protective, right? In the US, you have a lot of legislations that protect investor rights. And what if there is a crime against, something? You have the protection to go for a legal lawsuit, file a case, and win remedies as an investor. Investor education is very strong here because we have better financial literacy and stuff like that. There's proper education, awareness is there. But investor education is not very advanced in some parts of the world. That can create problems. We just said, hey, you can raise capital anywhere across the globe. Internet pretty much levels the playing field, but you have these problems. Online discussion forums, you tend to say, suppose you get into all kinds of online discussion forums, like Telegram, right? They'll tell you, hey, invest money here in renewable energies right now, in medical equipment right now, in service industry right now, in the defense market right now. These are coming through from online discussion forums like Telegram. You have to be smart and you say, okay, this looks good information, but let me go check. Let me look at the fundamental analysis of the company, do the what you call as company specific, industry specific, and economy specific analysis. It's called the EIC, economy, industry, and company analysis. Then you also do the technical analysis. Look at the graphs, look at the extrapolation of how the share market is moving and how this particular company's stocks are moving. You want to make an informed decision, just not purely based on online discussion forums, which could be a good starting point. I'm not just discounting their presence. You have to be very careful of the quality of information that's out there on the internet space. And portals, you have different types of portals where you can go trade, and you have a lot of investment companies that have their online presence. You want to make sure you invest in, go to the right portal, not just go for a fake one. because in the Bitcoin space and fintech companies, I've seen a lot of people lose money because they are assuming that this particular portal is exactly the portal which is the real company portal. And they go to the wrong portal and make a transaction, their money's gone. It's disappeared. Maybe in a week's time, the portal doesn't exist. So all kinds of issues are there on online transaction, and then the kind of cyber law and policy kind of challenges that we face in day-to-day life. So as much as this presents you a great opportunity to have your startup company, if you're already an established company, it supports your expansion, raise more capital to support your expansion plans. These are all great opportunities. Internet provides great opportunities for access to capital, and also for you to be participating in the stock markets, sell shares, buy shares, and make money out of this trading process itself. It presents a lot of challenges for both buyers, investors, and sellers of stocks. So you have to be aware of all these as you step into the financial market space. So thank you. And if you have questions, please feel free to ask, and I'm more than happy to answer those questions.